Okay. Very quick reminder again, in case you needed one, that your third quiz is a week from today. Okay. Review session is next Tuesday, so I'll send out more details in case, you know. Yeah, exactly. No. Dressed up for me is not wearing a suit, but no, this is about as dressed up as I get. A couple of things. One is on the project I know you've been working through, and one of the issues you're going to run into is the information keeps shifting under you. Have you noticed that? You think you're done and then you're not done, and then you think you're done and you're not done. Get used to it. That's the nature of investing in corporate finance. It's never quite done. But at the same time, there is a date by which you have to be done for this class. So at some point you got to say, okay, this is it. No, April 23rd or April 25th. But try to use as updated as the information as you can get, because again, not all the numbers get updated as frequently. Your 10-year bond rate is going to be updated every minute of every day. Market price is going to get updated every minute of every day. The accounting numbers will get updated when they get updated, which is usually once every quarter for US companies, and perhaps once every year if you have some other. In most markets you at least get one intermediate report. Don't try to be consistent. Know what I mean by that? Don't say my financials ended as of December 31st, 2015, therefore all my other numbers should be as of that day. That's not the way to think about it. The way to think about it is that every single input you're getting the most updated number you can, which means you're going to get mismatches in calendar time. But that's okay, right? So try your best to get it as updated as you can, because there's no point doing a corporate financial analysis of a company in 2014. I don't care, you don't care, nobody cares. So it's as of right now. Right? To see, I mean, you're saying how much can happen in a few months. I just posted an update on Valiant on my website where I essentially valued them. You know how BCG has this matrix? You know, we talked about the stars, and you put companies in the matrix, and Valiant should be in a sense a cautionary note when you use that matrix, because it's gone from being a star a year ago to a cash cow 6 months ago to a dog right now. So I actually have three valuations of Valiant. Valiant the star, Valiant the cash cow, Valiant the dog, separated by 1 year. And you can see how much things can change in a few months. In the case of Valiant, I don't even have the excuse of saying I got new information. In fact, the information I got was that they have no information. Sometimes the absence of information is as critical as the presence of information. Okay? So let's go back to where we were on Monday. We were talking about designing the perfect debt for your company. And I said, think about what your company does. Think about a typical project for your company. Try to design debt intuitively based on that. And to me, that's a bedrock for designing debt, is if you understand your company, you can design the right debt for it. But today I want to get a little more specific. I want to talk about if you want to know whether you should be using 10-year debt or 8-year debt, how much of your debt should be floating rate? Should it be 30, 35, or 40%? I want to give you some indicators you might be able to use. Let me start easy. Let's assume that you're a company with a few really big projects. I gave you the example of Boeing, only 8 projects in its life. Or you could be an infrastructure company building a toll road in Mumbai, one big project. And you say, what's the right debt for this project? I'm going to take you through the process of figuring out what the right debt for a project is. But remember, this is the exception rather than the rule. Most companies, you fund portfolios of investments. You're a movie company, you produce 15 movies, 20 movies, 25 movies. We'll talk about what to do about those companies, but the process I'm going to go through is going to give you a way of coming up with the right debt if you have a few big projects. In fact, I'm going to take the Rio Disney theme park we analyzed. Now, when we did the net present value, we concluded it was a good project. Let's say you decide to take it and you're trying to think of what's the right kind of debt for this project. If Disney wanted to fund this project with the perfect debt, what would it look like? So what I did was I went back and I got the cash flows I used for my capital budgeting. So this is almost an add-on to my capital budgeting. So you have the cash flows and the terminal value. And in the third column, you see my present value at the cost of capital. So if you look at those first 4 columns, you're saying, why are we doing capital budgeting again? In the last column, here's what I've done. I've taken the present value you get each year and multiplied it by which year you get it. So in year 1, my present value is 920 minus 922, I multiply by 1. I take minus 730, multiply by 2. And I add up that last column. You're saying, what is that going to give me? I don't know whether you ever, I know you've done it, but you might not quite remember. But when you did bonds, do you talk about Macaulay duration or duration? What you do is you take the coupon each year, you take the present value, multiply by when the coupon comes in, you add them all up, and you divide by whatever so in this case, basically what you get is 18.91 is the duration of this project. What does it tell me? I'll give you the intuitive way to think about this. This is on average when this project delivers cash flows, 18.91 years from now. It's artificial because you get cash flows every year, but on a weighted average basis, this project's cash flows come in about 19 years. How does it help me? If I wanted to match debt up perfectly for this project, I would want debt with roughly the same duration of about 18.9 years. You're saying, why is it so long? Because the bulk of my value comes after year 10. So you can already see that if you have the cash flows on a project, you can actually use those cash flows to design the right debt for the project by computing the duration of those cash flows and matching up the duration of the debt to those cash flows. So all I've done here is taken the present value times T, the last column, and divided by the traditional net present value, and you get a duration for the project. So if you have standalone projects, you can actually do this to match up each project to its debt. So in the case of this theme park, if you ask me to design the perfect debt, I'd probably make the duration about 19 to 20 years. Okay? Remember, duration is not maturity. So if I issue 30-year bonds, the duration of a 30-year bond is probably going to be about 15, 16 years. So it's really long-term debt. Duration basically is if I issued a 0 coupon bond, that would be the duration of the maturity of the bond. But on a regular coupon bond, 19-year duration probably translates into 25, 30, 35-year loan. And if I could tie the currency to the currency of my cash flows and the interest payments to how well the theme park does, I would have a perfectly matched debt for this particular theme park. So if you have companies with relatively few projects and you have cash flows in those projects, you can match the debt up precisely to those projects. As I said, that's not going to work for most of us. For most of us, you're looking at a company like Coca-Cola, you're looking at a company like Walmart, you're looking at a collection of projects, hundreds of projects usually, and you're saying, how do I design the perfect debt for my company? Because you can't match it up by project. And I'm going to take you through a process by which you can at least try to get there. And I'll give you all the caveats, the limitations of the approach. What I'm going to do is I'm going to look at your history as a company. And I'm going to look at 2 numbers. I'm going to look at your operating earnings or cash flows over time. How much does it vary over time? And I'm also going to look at your enterprise value, which is the value of your company, market value of equity plus debt minus cash over time. What am I trying to find out? I'm trying to find out what drives your company's cash flows and value. And I'm going to focus in on big macroeconomic variables, things like interest rates and inflation and GDP. And I'm going to try to see if I can make sense of when your company does well and when it does badly. Why do I care? Because I want to create debt that does well when you do well and does badly when you do badly. I've got to figure out what is it that makes you tick as a company. Do you do really badly during recessions? Then if the answer is yes, I've got to design debt that tries to do that. How does inflation affect you? Do your cash flows go up with inflation? I'm going to use that to incorporate that into my debt. So what I did was I collected the data for Disney going back to 1985. You're saying, why go back that far? Because I need enough data to make this analysis. If I go back 5 years, I'll get too much noise. So I went all the way back to 85. I collected the operating income every year as my proxy for the operating cash flows of the company. You could use EBITDA if you prefer, but I've just collected operating income. I also got the enterprise value every year. And let me remind you again, it's market value of equity plus debt minus cash. That's all I'm doing every year. And you can see that if you look across this 30-year period, Disney started with about $369 million in operating income and ended up with $9.45 billion. It's a really good period. And its enterprise value increased from $3.5 billion to almost $126 billion over the period. So over the period, Disney clearly did well. But you can also see there are individual years where bad things happen. For instance, we talked about 2000, a year where operating income dropped. Okay? And in 2001, the market cap dropped. So basically, you can see there are individual years where the company's done well or badly. So I have Disney's history, and you can pretty much do this for any company with a long history. Then I went to the Federal Reserve website. I've sent you this link before. It's a site called FRED, which is a Federal Reserve data site in St. Louis. It is the most incredible macroeconomic data site I know of on the face of the earth. You want to know what the British pound US dollar exchange rate was in 1953? I don't know why you'd want to know that, but if you did, you could find it there. You want to know what GDP growth was in 1928, the third quarter? You can find that. So they have historical data, and it's incredibly user-friendly. You can download it right into an Excel file. In fact, they have a little app that you can put on your phone. This is for the geek in you. And you want to download GDP data while you're standing there waiting for the subway? You can do that too. So check it out, because what you can do is you can get the data on things like T-bond rates and GDP. And basically that's what I did. I collected the change in the T-bond rate every year going back to 85. So this is not the T-bond rate itself. It's the change in the T-bond rate. So the way to read this is in 2013, the T-bond rate increased by 1.07% from 2.1 to 3.17%. So each year I take the change in the T-bond rate. I also compute the percentage change in real GDP. So they have the GDP numbers, so the percentage change in real GDP. I looked at the percentage change in inflation. Is inflation going up or dropping? And then I also, on FRED, they have this data set called the weighted dollar. The problem with trying to get exchange rates is you can have 100 different exchange rates. They take a weighted average, where the weights are based on trade. So it's a trade-weighted US dollar. And the way to read that is when that number is positive, the dollar is getting stronger. When that number is negative, the dollar is getting weaker. So I have four numbers. I have a measure of how interest rates are moving, how inflation is moving, how GDP is changing, and how the US dollar is doing. I'm going to bring this data set in conjunction with the data set you saw on the previous page. Yes? I took the T-bond rate last year, T-bond rate this year, took the difference. It's not the percent. It's confusing, because when you go from 3 to 4%, there's a 33.33% change. This is actually just the absolute change from 4 to 3. So I'm just looking at the change in the T-bond rate from last year to this year. Okay. So now let me bring these together, and I'm going to ask 4 sets of questions about Disney. And I'm going to try to explain why I'm asking these questions. The first question I'm going to ask is, how does Disney's value as a company and how does its operating income change as interest rates change? Okay. So as the T-bond rate goes up and down, what happens to Disney's operating income? You're saying, who cares? The answer to that question is actually going to give me a measure of the duration of Disney's assets. Sounds mysterious, but let me take you through this process. I took Disney's firm value each year, the enterprise value, and I ran a regression. That's why I needed 30 years of data, because I need some data here. I took 30 years of data on Disney. I took the change in firm value, and I ran a regression against the change in interest rates. I know statistics is one of those things we tend to kind of gloss over. But how would I read that coefficient? What does it tell me? If interest rates go up by 1%, my firm value decreases by 2.32%. That's not unexpected, right? Higher interest rates usually are bad for stock prices. You're saying, big deal. I'm going to argue that that 2.32 is actually a measure of the duration of Disney's assets. You're saying, how do you make that leap? Let me go back and review bond duration. Right? We use all these different ways of measuring bond duration, but if you step back and think of what the duration of a bond is, it's a percentage change in the bond price for a given change in interest rates. In other words, when you tell me the duration for a bond is 9 years, you're also telling me that if interest rates go up 1%, roughly speaking, the bond price is going to drop by 9%. It's not the way we usually think of duration. We think of it as time, but it's also it's basically a measure of how sensitive is your bond price to changes in interest rates. So when I give you the duration of a bond, I'm saying for a 1% change in interest rates, this is how much the bond price changes. Let me take you back to the previous page. What did we say this was? When interest rates go up by 1%, the value of the firm drops by 2.32%. That sounds very much like what I just said about bond prices, right? So when I run a regression of firm value against changes in interest rates, the coefficient that I get is going to give me a measure of the duration. It's going to be negative, obviously, because interest rates go up, prices go down. But that's going to give me a measure of the duration of Disney's assets. You're saying, why are you going through this convoluted way? Why don't you do the same way you do it for a bond? For a bond, the reason we can compute duration just using coupons is we know what the coupons are going to be for the future. Right? So I can give you the coupons for the next 10 years. So in a traditional bond, we actually know the cash flows. The cash flows are fixed. So in a bond, the coupons don't change as interest rates change. So when interest rates change, all I need to do is compute the present value of the same coupons. So in a bond, I'm not going to run a regression. I have a much more direct way of estimating duration. For a company, it's much messier doing what I did with a bond. Think of what I'd need to do for Disney. I'd have to give you the expected cash flows on Disney for the next 25 years. And I'll also have to tell you those cash flows will not change as interest rates change, which is almost absurdly impractical. So I'm going to take the shortcut. I run the regression of change in your value against interest rates and argue that that coefficient is going to give me a measure of duration. So if you believe this regression, Disney's assets should have a duration of roughly 2.3 years. You're saying, what do you mean if you believe? I forgot, I didn't draw your attention. What does the Tstatistic tell you? That is almost all noise, right? And that shouldn't surprise you. Macro variables will explain relatively little. But if you're willing to look past the noise, then you're saying 2.32. But there's a big caveat. Maybe it's 6, maybe it's -1. We didn't quite get it, right? So I'll talk about what to do about that, because these regressions are always going to be noisy. But that becomes my measure of duration, because it tells me how much my value as a company changes for a 1% change in interest rates. Now, just to see how much my income, so with each of these variables, I'm first going to look at how much my value changes, but I'm also going to look at how much my income changes. So I've told you that if interest rates go up, my value decreases. Let's see if that's true for my operating income as well. So I took the same change in interest rates, but instead of looking at changes in Disney's value, I looked at changes in Disney's operating income. So think of how I'd read this. Every 1% increase in interest rates reduces my operating income by about 7.9%. So my income is much more sensitive to changes in interest rates than my enterprise value is. Don't take that as a generalization. For some companies it can be reversed, but for Disney, their income turns out to be much more sensitive to interest rates than their value is. So the 7.9 is a measure of how sensitive my income is to interest rates. So at this stage, here's what I have. Higher interest rates are not good for Disney. We kind of knew that, but we now have a measure of by how much. And we also, to the degree we believe that firm value regression, have a measure of the duration of Disney's assets. Any questions? Here's the second regression I ran. I took the changes in Disney's value and changes in operating income and ran a regression against changes in real GDP. What does that tell me? When I look at how my company's earnings and value are doing relative to GDP, talk about cyclical and non-cyclical often in very qualitative terms. What's the definition of a cyclical company? It's a company that tends to move with the economy, right? So if you define the economy as real GDP, if I have a cyclical company, when GDP goes up, my income and my value should go up. When GDP goes down, my income and value should go down. That's what I'm trying to find out. Is my company a cyclical company without the storytelling? Let's see what the results look like for Disney. When I looked at the firm value of Disney and regressed it against GDP growth, every 1% increase in GDP growth increases my firm value by about 6.7%. Every 1% in GDP growth also increases my operating income by about 6.6%. So how would I read that? Based on the numbers over the last 30 years, it looks like Disney is sensitive to growth in the it's more cyclical than we thought it was. Its income and its value are sensitive to what happens to GDP, and these statistics are actually significant. Unlike the interest rate changes, here it actually seems to make a difference on what Disney's value and operating income is. So if you truly have a non-cyclical company, a food processing company, those coefficients should be what? They should be close to zero. If you have a counter-cyclical company, sometimes people tell you stories about a company that moves, then those coefficients should actually be negative. So read the coefficient, but take it with a grain of salt. Yes, Michelle? I'm going to use the traditional statistical rules of thumb, right? T-statistic greater than, when you get to 1 point, so when you look at the T tables, when you get to about 1.6, 1.7, 1.8, you're getting to about a 90% confidence. When you get to 2, you're getting to 95% confidence. When you get to 2.5 or 3, I mean, at least based on this data, you're getting to a point where you feel almost certain that the relationship applies. Okay? My daughter actually, so there's a complete tangent. She hates numbers. She's a story person. So she's finishing up a senior year at William and Mary, and she has a project to do. And she hates econ. She hates any numbers classes. And the professor has given her this project on, first she has to come up with a project, so I gave her an idea. That's what dads are for. I said, why don't you look at it's a sports economics class, why don't you look at the relationship between the value of an MLB, value of a sports franchise, a professional sports team, and the size of the media market. You know why I gave her that? I know exactly what she's going to find. This is exactly the kind of project you want to do in your senior year when you really don't want to spend too much time on results at work. So she took the Forbes MLB valuations. I suggest she try two different sports, baseball and football. You know why? Again, I know what the answer is going to be. Baseball, it's going to be very sensitive to the media market size. Why? Because Major League Baseball allows teams to keep their local TV revenues, the bulk of them. In NFL, it's going to be much less sensitive to the size because NFL teams have to throw their entire TV revenues into a pot. You can't keep it if you're the New York Giants. And of course, she found all the results. And the question, of course, she asked me today is, I've run all these regressions in SPSS. I have no idea what they're telling me. Can you write up the report for me? I said, no. I'm not going to do that for you. She said, what am I going to do with all these numbers? And I said, just focus in on the T statistics. If it's greater than 2, just put in the word statistically significant and move on. Right? And in fact, it's a pretty good rule with these regressions. Just focus on T statistics because you get all these other numbers, F statistics. I know there are other things you can read off the numbers, but the T is what I'm going to focus on because to me it kind of captures whether there's a statistically significant relationship. The third variable I looked at was the weighted dollar. Yes?
In terms of the duration of business assets, how would you interpret the 2.3 years?
Well, when I put design, remember we talked about matching debt up to the assets. To the degree that I believe that the duration of the assets is 2.3 years, when I take the duration of all of Disney's debt, I want it to be 2.3 years as well. That's why it's so significant, because I'm going to use these numbers to make a judgment on whether Disney has the right debt now. But the problem I have with the 2.3 is it's a very noisy number, right? The T statistic is low, the noise is going to be high. So we'll come back and look to see what we can do about these low T statistics, because it is going to be an issue no matter which company you're looking at. Okay? Yes, Elliot.
Both these portfolio questions are typically average.
Yeah.
And for the project where it's very specific, why or how can you focus on that one average number? Who do you structure the debt according to the actual expected cash flow?
Well, when you have hundreds of projects, two things happen. One, it becomes impractical to match up each project to its own debt, right? The second is because the projects have interactions, how you fund, you can have a portfolio of risky projects that actually gives you safe cash flows. So one of the reasons when you have a portfolio of projects, you want to focus on the total earnings and the total cash flows is to the extent that they move in opposite directions, you might be able to use very different debt than you would have with each individual project being matched up. So that's why I said if you have lots and lots of projects, go to the portfolio approach, not only because it's easier, but probably because it's going to give you a better answer. Exactly, or more likely retuning your debt, right? Because you're a big company, you're not reissuing all your debt, but you're issuing new debt, repaying old debt, but what you do at the margin will be to try to push you back to where you'd like to be. Okay? Then I think you have to think, if it's a specific big project, then you can think about funding that project with its own debt, and then you can use, then you have to do what you did in capital budgeting. You almost have to view this as an extension then, right after you did the net present value of the project, you'd add this extra layer of saying, I've concluded this project is a good project for Disney, Rio Disney. Let's compute the debt that would go with that project. And there you can match it up to that project, but then you got to leave that debt with that project and hope that the collection of projects you have, you're still matched up. Okay? And so that's why if you have relatively few projects, you can get away with project financing. Otherwise, it's probably best to look at the portfolio that you have as a company.
In that Rio Disney example, how does it make sense to say that the debt has a duration of 18 years? Like, is it all payments were due in that year?
No, because the duration of the debt is 18 years. I'm not going to issue 18-year zero coupon bonds, right? I'm going to issue a 30-year bond which will have coupons every year. So what I'll use is the earnings on the project each year as I go through to make the interest payments each year. The principal is not going to get due until year 30, but by then the theme park is a cash cow. I can accumulate the cash to pay off the debt. So when we talk about duration, we're just saying that whatever debt you issue, whether it's floating rate debt, fixed rate debt, the duration of that debt has to be roughly 19 years. I'm still going to leave the design of the debt to you, and you can be flexible in how you design the debt to match it up to the projects. Okay? Any other questions? Yes. Mm-hmm. You could. The problem with multivariable regressions is what's got to be true about. Did everybody get the question? I'm running 4 separate regressions. The question is, why not save some time and run one multiple regression? I could take you back to Stat 101. When you run a multiple regression, what has to be true about the independent variables? They've got to be independent of each other. What are the variables I'm using? Real GDP, interest rates, inflation, and the weighted dollar. There is zero chance that they're going to be uncorrelated with each other. That's my concern. If I throw them all into the same regression, I'm going to have multicollinearity. Remember that magic word that statistics professors use? I never quite got it when I actually took statistics. I kind of get it now. Because when you throw these variables in, it's going to create a mess in terms of the coefficients because they're all going to tend to move with each other. And the spreadsheet is going to get really confused about what's standing in for what. So that's why I've separated them and run 4 separate regressions because there's too much collinearity, too much correlation across the variables. Okay? Yes?
On that note, would a company's beta time after a lot?
Exactly. The beta is basically capturing all these macro variables from an equity investor's perspective. So think about it. We're doing 2 different things. That we use beta to capture the cost of equity because we want to measure exposure to macroeconomic risk. Here we're using the same data broken down into pieces to answer a different question. What's the right kind of debt? But you're absolutely right. The beta is kind of an aggregated version of all of your macroeconomic exposure in one number. Okay? So now let's look at the third regression. Third regression, what I did was I took my operating income and firm value and regressed it against that weighted dollar number. Remember that weighted dollar number. When it goes up, it means the dollar is getting stronger. When it goes down, the dollar is getting weaker. Again, here, I wasn't sure what my priors would tell me. I mean, when a dollar, tell me the story about Disney. As the dollar gets stronger, what should happen to Disney? Should it be helped or hurt? Don't look at the regression, just think about the intuition. Dollar gets stronger. The businesses that will be hurt the most will be your theme park businesses, especially in the US, but now that they're increasingly opening theme parks outside the US, it gets messier. If both your theme parks were in the US, a stronger dollar is going to hurt you. Why? Because anybody coming into the US then, whenever the dollar gets strong, it's like having a price increase on your thing. The movie business, it's kind of messier, right? I'm not sure how that works. If your costs are all in dollars and your revenues are in another currency, who knows? So this one I'm completely diffused, but that's why I'm curious about what the numbers will tell me. Because this is a case where I could tell you a story on one side or the other. But by running this regression, let's see if in fact Disney is helped by a stronger dollar or hurt by a stronger dollar. Again, remember, if the coefficient is positive, if the coefficient is positive, it means your company is helped by the dollar. If your coefficient is negative, it means you're hurt by the dollar. Okay? So here's what the numbers look like. Every 1% increase in the value of the dollar gets stronger, causes my firm value to drop by 0.57%. So it's a mild effect. The T-statistic is not that significant. So the value is affected, but not by very much. So it's negatively affected, but not by very much. But when I ran the same regression with operating income, a stronger dollar reduces my operating income by about 1.68%, and here the effect is stronger. Disney's operating income is affected much more strongly by the dollar, and in a negative way, than its firm value is. Yes? It's a weighted dollar. Basically, it's a trade-weighted dollar. So basically, it takes every currency that the dollar's against a dollar, and it weights them based on how much trade the US does with each currency. And the reason I'm using that is otherwise I'm going to be running regressions against 16 different exchange rates. And God only knows what the end result will be. So I'm just taking one number as a consolidated measure of is the dollar getting stronger or weaker. You could, but then I'd have to break the... But in a sense, I don't care, right? When you invest in Disney as a company, you're exposed to it as a company. So the individual countries, if they all average out, why do you care? So in a sense, I'm much more interested as an investor in how the company is affected by a stronger dollar than each individual piece. Because maybe it all averages out at the end. And that's what this end result will tell you. Is it getting averaged out? In the case of Disney, it's not quite. Across the businesses, across countries, it still has a negative impact. Yes?
Can this be dangerous because over the 30 years that you ran the regression against the...
Oh, absolutely. It can be dangerous in so many different levels. I don't even want to go there. It can be dangerous because the world has shifted. It can be dangerous because I'm being very US-centric, right? And the reality is we have global companies in a global environment, and it's dangerous because Disney has changed dramatically as a company over the last 30 years. 30 years ago, it was a movie-making company with a couple of theme parks. Now it's an entertainment company with ESPN and broadcasting arms. So there are lots of problems with historical data. Remember all the problems we talked about, beta regressions? Take those problems and multiply them by 10. And you got the problems in a regression like this, where you're going back long periods and running macroeconomic regressions. But I'll give you a solution, and you can decide whether you like it or not. But with each individual regression, you've got to take it again with a grain of salt because of all those factors. Okay? So in this case, at least, Disney looks like it is being hurt by a stronger dollar, and that's got to be fact. Again, all of these questions I'm asking because I wanted to help me design the right debt for Disney. Last regression I ran was against inflation. Again, tell me what this is going to tell me. If I run a regression of firm value and operating income against inflation, when I get a positive coefficient on inflation, what's the regression telling me? As inflation goes up, what happens? My operating income and my firm value go up. You're saying, what does that even mean? But we talked about pricing power. If you're a company with pricing power, what does it mean? You have high inflation, you can feed it through to your customers. If I have a company with pricing power, I should expect to see strong positive coefficients, at least on my earnings number, because I can feed the number through. Value is a little messy, and you're going to see why. So let's see what the numbers look like for Disney. Every 1% increase in inflation pushes up my firm value by about 3%. But the coefficient is not really statistically significant. Every 1% increase in inflation pushes up my operating income by about 8.2%. And there the statistical significance is clearly, it's 2.76, well beyond the 95th percentile. So what do I read out of this? Disney has the capacity to pass inflation through into its operating income. How do we know? All you have to do is look at the ticket prices for Disney theme parks going back in time, and you can see their pricing power. So this is no surprise. And the reason value is less impacted is, remember, the value is a function of both your cash flows and your discount rate. Right? So when inflation goes up, let's say you can pass through inflation into your cash flows. Your cash flows are higher, but if inflation is higher, what else is going to change? We talked about risk-free rates. What's a big driver of risk-free rates? Higher inflation. So if we have higher inflation, it is a double-layered impact. Your cash flows are higher and your discount rate is also higher. So the effect on value is more muted than the effect on earnings, but at least we have a sense of whether Disney has pricing power. Again, I'm not going to get too excited about any of these regressions, but to the extent that I believe these regressions, notice how much I'm hedging. Disney's duration is roughly 2.3 years. It is affected by economic cycles. It's become more cyclical over time. It is hurt by a stronger dollar, and it has pricing power. But as I said, lots of noise in the regressions, low R-squareds, low T-statistics. Yep.
So when you're calculating the liability side duration, are you counting working capital as...
Working capital is not part of your... If you don't count working capital, it's debt for your cost of capital. You can't start counting it now, right? And we never did. It's all interest-bearing debt and lease commitments. That's it. So we don't get a chance to revisit the definition of debt for different parts and define it differently. So the minute we define working capital as part of the operations and operating cash flows, it can no longer be counted as debt when you do this part of the analysis.
The duration is very low then, right, of the assets?
Yeah, but it's not an asset. It's not debt. Right? Working capital is part of your operations, inventory, accounts receivable, accounts payable. So that, from that perspective, it doesn't even enter my analysis. It's purely interest-bearing debt and leases that I'm asking this question about. Okay? So here's my solution. When we ran the beta regression, and I said, I don't trust this regression, it's too noisy, there's a big standard error, low T-statistics. You know what my solution to that was, right? I drew on the law of large numbers, which effectively meant I took 70 companies in this sector, or 100 companies. I ran beta regressions across all of them. Each beta was crappy, but then I averaged out the betas, and I said, this beta looks good. So that's what I did with each of these 4 regressions. Rather than use Disney's numbers, which have these huge standard errors and low T-statistics, I ran this regression for every company in the sector. Here's a pain in the neck. I do this only once every 10 years, and then I live off the numbers for about a decade. I'm in the 11th year now, and I've been too lazy to redo it. So it takes every company, so basically I go back and collect 25 years of earnings and value for each one. I run a regression for each company against these macro variables. Each company, I get numbers very much like Disney, low T-statistics, big standard errors. Then I average out the numbers across the companies. What does that mean? If you look at, for instance, across all, and the advantage here is I can do what I did with my bottom-up beta. I can break Disney down by business. I took all broadcasting companies, and the average for the regressions across all broadcasting companies gave me a duration of about 3.7 years. And I did this for each of the 5 businesses that Disney was in. I did it for inflation, I did it for GDP growth. I've essentially done what I did for Disney for each individual business, and I'm going to plug those numbers in for each of Disney's businesses. I don't know whether you remember, but remember we weighted the 5 businesses of Disney based on revenues they got in each business and estimated value? In other words, I'm stealing from my bottom-up beta calculation and using it in a different context, and that's why the earlier point about, hey, this looks a lot like what you did with betas is actually very true. I'm doing what I did with betas in a different context. And those weights are what I use to come up with the weighted average for Disney. So if I use these bottom-up numbers instead of the top-down, 1 regression numbers, the duration of Disney's assets is not 2.33, it's more like 4.34. Disney is not that sensitive to GDP growth. Disney doesn't have much pricing power, and Disney is negatively affected by the US dollar. There's a price you're paying, right? Because you're replacing the company-specific numbers with industry averages, but the benefit you get is the numbers are much more precise. So let's see where I am now. All of this was directed towards my designing the perfect debt for Disney, right? I'm going to use the data from this table to start designing the debt. So if I believe this 4.34 number, Disney's debt should roughly have a duration of about 4.34 years. Okay? Disney has pricing power. So a significant portion of Disney's debt should be floating rate debt. Disney gets lots of cash flows from outside the US. A significant portion of Disney's debt should be foreign currency debt. So when I look at Disney's debt, and this is even before I look at the liability side of the balance sheet, this is what I expect to see. Debt with roughly the duration of 4.3 years, a lot of floating rate debt, and maybe 18, 20, 25% foreign currency debt, reflecting the currency they get the cash flows in. I open up the liability side to see what Disney actually has. Disney's debt has a weighted average maturity of about 7.9 years. Maturities and durations don't exactly match up, but if you have a maturity of 7.9 years, is the duration of that debt going to be lower or higher? It's going to be lower. It's close to 5.5 to 6 years. I'm at 4.3 years. I'm not going to freak out. You're close enough. You know, when you'd be in trouble is if the duration of your assets was 25 years and you look at your debt and it's all 2-year debt, then you got an issue. For Disney, I'd like the debt to be a little more long-term than it is right now. I'm sorry, a little more short-term than it is right now. And I'll file that away. They have about 5.5% of their debt in floating rate debt. But it looks like they have a lot of pricing power, right? In fact, it's not just the numbers. It's the fact that we can observe what they can do. And with the amount of pricing power they have, 5.5% looks like it's a really low number. So I'm going to file that away. I'd like to see a lot more floating rate debt, or at least a little more floating rate debt than they have. And only about 5.67% of their debt, I'm sorry, 5.67 is the floating rate, only about 5.5% of their debt is foreign currency debt. That again looks low. Again, you know, given their own breakdown of revenues, 18% comes from outside the US, they have only 5.5%. So it looks like their debt is a little too long term, a little too US dollar, and a little too fixed rate. Say, well, now what? It's a fixable problem, right? Let's take the most extreme way you can fix a problem. You can repay all the debt in your balance sheet, replace it with shorter term, floating rate, foreign currency debt. Or no, that's a lot of pain. So here are some of the things you can do. You can do some fixes. You don't even have to do anything extreme. And this is where I think markets give you more options, more choices now than you used to have. Now, I'm sure you've run into swaps in your foundations class and then all this neat stuff about pricing swaps. Frankly, the only reason I care about swaps in corporate finance is it lets me swap out of some of the debt I don't want to have into debt I'd like to have. So in this case, what do? I try to swap out some fixed rate US dollar long-term debt for floating rate foreign currency short-term debt. My problem almost instantaneously starts to go away. So I can use swaps. Last session, people talked about using futures markets or options markets. That's another advantage we have now. If I want to make my dollar debt into foreign currency debt, I can use derivatives to actually make my debt into foreign currency debt. So futures and options can come into play. So I can use swaps of futures and options, or derivatives markets, to kind of fix the problem. That's the first choice. If you don't want to go that route, I have a second choice. Disney's building its Shanghai theme park, right? But let's say it's another big investment coming down, another $6 billion investment it wants to make in 2 years. Let's make this investment an investment right in the middle of the US. And it says, what debt should we use? Normally it'd say it's right in the middle of the US, all the cash flows are going to be US dollars. Let's use fixed rate US dollar long-term debt. I'm going to suggest that on your new investments, you basically go out and take a lot of floating rate foreign currency debt, even if it's mismatched, because again, you're looking at the entire company. So there are lots of little ways in which you can move to that right mix for you. But it starts with you telling me what the right debt for your company is. Now, how long-term should it be? How much should be floating rate? You can see it's fuzzy, right? When I said should have more floating rate debt, you asked me how much more? I don't know, 25%, 30%. So in a sense, I can't give you a precise answer. I just know that 5.5% or 5.76% is just not enough. Okay? So in some companies, that gap will be large, and you're trying to fix it as best as you can. Any questions on reading existing debt? Now remember, if a lot of your debt is lease debt, that's debt too, with its own specific characteristics. It's much more difficult to fix lease debt because it's connected to individual stores and investments. So if you're a retailer and you don't like the debt you have, it might be much more difficult to get around that problem because it's a lot less flexible. You can't go in and say, can you make it floating rate lease debt? I don't even know what that means. Okay? So you're kind of stuck with what you have if the bulk of your debt is lease debt. So let me do very quickly the other companies because I could do what I did for Disney for these other companies, but I have two problems. One is I don't have the kind of historical data for a Bookscape or a Baidu to do the regression. So I'm not even going to try. I'm going to do it almost entirely on an intuitive basis. If I look at Bookscape, it's a retailer. Its biggest asset is a store. I actually think it makes sense for them to just lease the stuff and let it go. That's debt attached to the store. And in a sense, it's debt you can walk away from and abandon the store, and the lessor will take over the real estate if the store doesn't really do well. So for Bookscape, why mess with a good thing? Leases seem to be the right kind of debt. I'm going to let it go. When I look at Vale, mining company, typical investment is really long term, and it's connected to the price of iron ore or whatever commodity it is. If I were designing the perfect debt, it would be really long-term debt because of the long-term nature of the assets. Dollar denominated primarily because I sell into a dollar-based market, but I have to worry about the fact that my mines might be in Canada or Brazil, so I might have to use derivatives to hedge against that because it depends on where the mine is. And if I can, I'd like to tie the coupon to commodity prices, right? Vale wishes that they had done that. If they tied the coupon rate to iron ore prices, they wouldn't be in the trouble that they are in right now. Their actual debt is primarily US dollar debt. That makes sense. The average maturity is 14.7 years, which again makes sense. It's long term. None of the debt, as far as I can tell, is linked to the price of a commodity. Okay? Maybe that's fixable. When I look at Tata Motors, typical investment for Tata Motors is a big manufacturing plant. Now, it used to be primarily in India, but as you get Jaguar Land Rover kicking in and becoming a bigger part of the company, it's going to start to get global. So if I were looking for debt, I'd look at medium to long-term debt, reflecting the fact that their investments tend to be these big plants, 10, 15, 20-year lives. Fixed rate debt, because the pricing power that Tata Motors has in India is relatively low. They can't adjust prices and pass inflation through. And the mix of currencies reflecting where they get their revenues. And to the extent that you look at their actual debt, it's mostly Indian rupee debt, which for the moment might be okay, but it's increasingly going to become an issue as Jaguar grows. And the maturity of the debt is about 5 years, and most of the debt is fixed rate debt. So with Tata Motors, again, the existing debt is pretty close to what you'd expect for the moment. And finally, for Baidu, young technology company, growing fast. It's a company where the right kind of debt would probably have a conversion option to take advantage of the fact that they have growth. And it should be in local currency because almost all their revenues are in China. And here there's a tremendous mismatch. Tremendous mismatch in what sense? About 82% of Baidu's debt is in foreign currencies, US dollars or euros, which doesn't make sense given the fact that they get their revenues in China. Hopefully they're hedging that risk with some kind of exchange rate, futures or options aside. The average maturity is 5.8 years, and there's almost no convertible debt. So with Baidu, there's a very real chance that you could fix a little bit of the mismatch problem by replacing their existing debt with more convertible local currency debt. So again, think about your company. So start off by saying, what would I expect to see as my company's debt? Look at what it actually has. If there's a mismatch, please tell me what the company can do to fix it. If it's a growing company, it has lots more tools at its disposal because new investments need debt. If it's an existing company, you might have to draw on swaps and derivatives markets to fix that mismatch. Yes, Elliot?
If this analysis is telling us something about what the currency mix should be, how do we compare that with just the currency mix of the revenues?
Well, I actually draw a pie chart, basically, of the revenues and draw a pie chart of the debt. And if they're mismatched, ask what's going on here. In the case of Baidu, if I do the pie chart for the revenues, it's all in Chinese yuan. Then I draw the pie chart for the debt. 82% is in US dollars and euros. Something is off, right? I mean, it doesn't make sense. Yeah.
You were also doing the regression, right, of the sensitivity to the US
or but I'm doing it as a weighted currency, right? So basically all that will tell me is a dollar helped me or hurt me. It doesn't tell me about individual currencies. For that I still have to go back to the actual currencies that the revenues are in and do the pie chart in it. So that regression is more a general sense of should I worry about currency mismatches in general? And the regression says yes, you should, but it doesn't tell me much more than that. I still have to do this matching up to make sure that I'm okay. Okay? Yes?
What's the reason that very little of the value debt is going to go?
I think part of it is you live in the market you're in, not the market you wished you were in. I'll give you an example. Until about 10 years ago, if you went into any emerging market and you looked at what companies had a debt, they had 3-year fixed rate debt. That's it, every company. Saying why? That makes no sense. You know why they had 3-year fixed rate debt? Because that's what banks would lend you. They wouldn't lend you 30 years, they wouldn't lend you floating rate. So when you're completely and totally dependent on bank debt, there's nothing you can do except take the terms you have. And that's why the biggest mismatches today are in emerging markets, because many old companies have debt on their books that makes absolutely no sense for them because it is the debt they used to take. What's changing, and you're starting to see this around the world, is bond markets are opening up around the world. But those bond markets initially are just conventional fixed rate coupon bonds. The floating rate bond market, the convertible bond market are still relatively young outside the US. US companies have been able to use convertible debt for a long time. So I think again it's a question of taking advantage of markets as they open up and saying, hey, this isn't 1985 anymore. You're not stuck with 3-year fixed rate debt. Go out and do something that better matches what you have as a company. Yes? I think any time you have a long, my rule is very simple. If you have a long-term risk exposure, just bring it into your actual financing. If you have short-term risk exposures, then go out and use forward. I'll give you an example. You take Boeing. Does it have substantial foreign exchange exposure? There are lots of contracts. But the problem with Boeing is it shifts from year to year depending on who they're selling the planes to. So if I were trying to design the perfect debt for Boeing, I'm not going to try to match the debt up to its pie chart right now because that pie chart could look very different. That's a clear case where using derivatives makes sense because on a year-to-year basis, your risk is shifting. So what I do as a company is look at how much of my risk is it's like working capital. How much of it is always there and try to bring it into my debt, and how much is transient. And the transient part, I'm going to use swaps and options and futures to kind of hedge because it's going to shift from year to year. Right? Because the only people you end up making wealthier by doing derivatives constantly are the people who sell you the derivatives. And why make them wealthy? I mean, they're wealthy enough as is. Yeah? So in a sense, you want to bring as much as you can into your operating and financing decisions and reduce that year-to-year management as much as you can as well. Right? Any other questions? Yes? That's actually a very good question. You know what a pegged exchange rate is, right? In fact, I've been hearing this question a lot from Middle Eastern companies because for a long time, the Saudi riyal has been pegged to the US dollar. And they say there's no exchange rate risk here, so they use the US dollar risk-free rate. But the problem with pegs is they can be unpegged. You say, why would a country do that? Because it has no choice. What might cause the Saudis to unpeg the riyal? If the oil prices keep dropping to $30 to $25 to $20, they have a budget problem already at $35. At $20, the only way they might be able to relieve themselves of that trouble is by unpegging. So I think it's a very dangerous assumption. If you're a company, you say, I'm pegged, so I don't have to worry. I'll borrow in dollars and fund everything in rupiah. Because we've seen this play out every time there's a devaluation or an unpegging. You see entire groups of companies go bankrupt because they've mismatched that. It happened in Argentina in the late 90s. Okay? But it's not just Argentina. Every time you see an unpegging, you see about a third of the companies in that market essentially run into trouble because they borrowed on the assumption that this was not a problem. And I always think that's a dangerous place to be. Okay? Any other questions? Yes?
Why do you not have an convertible debt? Don't you think it could also be because of the complications to do the legal structure of ownership?
That could be. It could be a control issue. The question was, maybe the reason they don't want to issue convertible debt is when you convert debt, what does it get converted into? equity, and if you have a control fetish, it's the right word I think to use, like Las Vegas Sands will never issue convertible debt. You know why? Because Sheldon Adelson owns 51% of Las Vegas Sands, which means any conversion could make that 49%. Baidu does have one protection, though. They have two classes of shares. So maybe they can make it convertible into the other class, but there is a control issue, which is you don't want to give up equity, and therefore you might not want to make your debt convertible. Yeah.
And also, I would like to assume that that debt that is got in US dollars is really foreign debt.
It's foreign debt, yeah.
So already the issues in China, right, about foreigners owning companies.
Yeah, maybe there's control issues, nationalism issues, I mean, who knows what other reasons, but that doesn't take away from the fact that they have a problem. They still have to fix the problem, maybe in the derivatives market, but they do have a mismatching problem. Right? So there might be a good reason for the mismatching, but there are also ways you can still make the mismatching go away without actually issuing convertible debt. Right? Any other questions? Yes?
What's the ratio you think of companies that have the right debt design versus those that kind of don't consciously think of this? And do you think that the reason that some companies don't apply this level of thinking is either lack of understanding or maybe like a timing issue, like does this take a long time to convert, to sell it internally?
I don't think it's a second anymore, right? Because in a sense, there's no reason what. On the first one, I'll reframe the question. What percentage of companies do you think let investment bankers tell them what the right kind of debt for them is? And what percent of companies think about the right kind of debt from within? And I think that really is the answer to the first question. Is if you let somebody from the outside tell you what the right kind of debt for you is, you're like the person who walks into an electronics store to the salesman and says, what's the right kind of TV for me? You're always going to end up with a 17-inch flat and plasma TV, right? Because that's what they... So in a sense, I think companies say, hey, these guys are the experts in capital markets. They must know what's right for me. Therefore, let them tell me whether I should be issuing. And in the early 90s, we'd all be issuing trust preferred if we'd listen to the banks because they made a lot of money on it. So I think it's really a question of, do companies feel the confidence that they can make these decisions? And they think it's... And I think the reason they feel it's complicated is they look at the choices, right? If you made a list of every conceivable debt, you're going to get very quickly overwhelmed by your choices. I think instead what you have to think about is almost design the perfect debt for you first, and then look outside at the market and say what's out there and try to compromise. I think that's a much better way of getting a handle on this question. Okay. Yes?
Do you have different margins on different businesses?
Being the investment bank?
No, you being the company.
But how can you have different margins if you're the company?
You have two different businesses, or
Oh, you have businesses with different operating margins. Okay.
should you use EBIT of those businesses instead? Because the margin will vary. Maybe your debt.
The way I dealt with that is I didn't use revenues, right? Basically, what did I use? I used revenues and I multiplied by a multiple of revenues in each business. That multiple will tend to be higher in business with higher margins. So the way I brought it in was through that multiple rather than by using EBIT. But you have a good point. I service debt with income, not with revenues. So instead of using revenues, you want to use operating income. That's perfectly okay to decide how much to borrow and how to borrow money. Okay? So let's look at the last piece of dividend policy. Okay? In fact, I'm going to start with a statement that I think it's going to cut to the heart of how I think about dividends. We tend to talk about companies having a lot of cash. Apple has $200 billion in cash. Google has $80 billion in cash. And I think we miss the point when we say this. Companies actually have no cash. Sounds like a silly thing to say. They hold stockholders' cash for them. It changes the power in which you think about who's setting what. Because in a sense, Apple doesn't have $200 billion. It's holding $200 billion of its stockholder cash. And that's going to frame how I think about dividends, because there are two basic questions I want to try to answer. One is, when I look at a company, the first question I have to answer is, how much cash can this company afford to return to its stockholders? Right? As opposed to what it actually does. And the second question I have to answer is, in what form? 30 years ago, I wouldn't have had to ask the second question, because there was only one way you could return cash until about 30 years ago, which is you paid dividends. Increasingly, as you're going to see in the US, you see a shift away from dividends into other ways of returning cash. So let me frame this process. We've talked about the investment decision, the financing decision, and the dividend decision. Remember how I defined equity? Equity is a residual claim, right? What's the definition of residual? You get whatever's left over. If companies were approaching dividend policy rationally, it should be the last step in the process. Put differently, I should start off by looking at what my investments are throwing off in cash flows. Then I should take those cash flows and look to see what I can make as new investments. I'm going to look at, do I have positive net present value projects? And after I've made those investment choices, if there's any cash left over, I decide how much cash to hold on to and how much to return. So in a logical world, this is the way things are supposed to work. You're supposed to start with your operating cash flows, look at your investment choices, look at your financing choices and what you're going to do, and then whatever's left over gets paid out in dividends. Do you think that's the way the real world works? The real world, I think often it gets reversed. And here's what I mean by that. Dividend policy, more than any other aspect of corporate finance, is dysfunctional. Dysfunctional in what sense? Last week when I was at Houston talking to Royal Dutch Shell, one of the things we talked about was oil company dividends. In oil companies, here's what they're doing. They're setting dividends up front. Based on what? Based on what they paid last year. And then they're working backwards from there. We've already paid $9 billion in dividends. That's how much Royal Dutch paid last year. Now how do we fix this problem? And how they fix the problem is, we've already paid the $9 billion, we've got to borrow money. Oh, that doesn't work, we've got to cut projects. So it's almost like dividend policy is driving everything else rather than it being the end decision. I know it doesn't make sense, but I think it is the reality we face, and it's driven by two things that I've talked about repeatedly in the class. One is inertia. Why do companies do what they do? Because that's what they've always done. Dividend policy, inertia rules. Most companies pay out what they did last year. It's almost like it's an autopilot. The second is Me Tooism. We talked about this in the context of capital structure, right? Why does Royal Dutch pay big dividends? Because every other big integrated oil company pays big dividends. Does the fact that they lost money last year, should it make a difference? Yes. But they're so caught up in being like everybody else that they can't get out of this trap. It is a trap that they're in, but it's a trap that they can't figure out a way out of. So one of the things we're going to talk about is, what do you do about companies that have got stuck in dividend policies that they can no longer afford? Because a big chunk of the commodity space, this is really true now. So what I'd like to do is actually lay out some, what happened to my graph? I know what's on that page, so I'll kind of describe this empty page. So it should be on your brain. Yeah? So I'm going to use some words to describe the way dividends work. And I'm going to start out with traditional dividends. If there's a word I would use to describe how companies set dividends, the word I would use is sticky. What does that mean? In most years, companies pay out as dividends what they did last year. So if you look at that graph, it actually breaks down each year the percentage of companies that increase dividends, the percentage of companies, these are US companies, percent of companies that decrease dividends, and the percentage of companies that essentially paid out what they did last year as dividends. So take a look at that graph and look at every year. In every single year, by far the biggest bar is the percentage of companies that did nothing to dividends. And among the companies that changed dividends, look at how many more companies increased dividends and decreased dividends. And this is over a 30-year period, and there's some really bad years there, recession years. 2008, even in 2008, more companies increased dividends and decreased dividends. So the first word I would use is dividends are sticky. Companies like to pay out what they've historically paid out as dividends. And in fact, the last quarter of 2008 for me was the ultimate test. If this was a crisis period, everybody was melting down, right? You think that this was the quarter that companies would cut dividends in? Even in the last quarter of 2008, the worst quarter that I remember in my 30 plus years in the market, in the S&P 500, 32 companies increased dividends, 17 decreased dividends. Even in that worst quarter, if in that last quarter of 2008 you don't see dividend decreases being higher than dividend increases, when will you ever expect to see that? So dividends are sticky. You think that's true in the US, is it true in the rest of the world? For much of the rest of the world, the answer is yes. You go to Europe, dividends are sticky. You go to Asia, dividends are sticky. In Latin America, there's a slight difference. absolute dividends are not sticky, but dividend payout ratios are sticky. You know what a payout ratio is? It's a percentage of earnings you pay in dividends. Latin America, perhaps the only part of the world where that ratio is more sticky than the amount of the dividends. And it's actually, the reason is actually very simple. Early in this class, I talked about Brazilian companies issuing two classes of shares. Common shares, which are really voting shares, and preferred shares, which are non-voting shares. Those preferred shares in much of Latin America come with a clause that if a percentage of earnings is not paid out as dividends, then voting rights have to be given to the preferred shareholders. So that triggers the payout stickiness, is they have to pay out 35% of their earnings as dividends no matter what. Okay? So dividends are sticky, and that's actually a good way to think about why companies pay what they do. So for most of your companies, when you look at what they paid in dividends last year, it's going to be very similar to the dividends, or the same number as the dividends they paid the previous year. And if it's going up, it would have gone up by 3% every year. And that's why I'm saying it's on autopilot. Nobody's really sitting there saying, what should we pay as dividends? Second, dividends tend to follow earnings. Keyword here is follow. They don't lead earnings. They're not contemporaneous with earnings. They follow earnings. Let me explain. You've got shares in a company that has a history of paying dividends. The company has a really good year this year. Its earnings are up 35%. Don't expect to see a dividend increase this year. You have 2 good years in a row. Maybe you'll get a dividend increase next year. You have 3 good years in a row. 2 years from now, you'll see a dividend increase. Dividend increases follow dividend earnings increases. Same thing with dividend decreases. Don't expect Goldman to cut dividends this year, even though they had a really bad quarter and perhaps a bad year. If they have 2 bad years, chances get greater. So dividends tend to follow earnings. They don't lead earnings. They're not contemporaneous. In fact, if you look at the dividend, which is the blue line, versus, you can see how much more stable dividends are over time, simply because of this fact that they tend to follow earnings. And the payout ratio actually goes up and down in the US. It's a dollar dividends that have this stickiness. Third, dividends are affected by tax laws. When we've talked about taxes so far, we've talked about almost entirely corporate taxes, right? The tax benefit that companies get when they borrow money. But now I want to talk about investors. You and I are shareholders in a company. We buy shares in a company. We get taxed. And we get taxed differently depending on what form our income takes. When you receive dividends, you have to pay taxes on dividends. When you receive price appreciation or capital gains, when you sell the shares, you have to pay a capital gains tax. And for much of US tax history, from 1913 all the way through 2003, the tax rate on dividends was significantly higher than the tax rate on capital gains. I'll give you a measure of how different. In 1981, the tax rate on dividends was 70%, 70%, because that was the highest ordinary, it was taxed as ordinary income, and the highest marginal tax rate was 70%. The tax rate on dividends was 28%. And that ratio of that capital gains taxes were 40% of the income taxes was true for about 25 years before that. And even after 1981, the difference narrowed only because the ordinary tax rate came down to 50 and the capital gains tax rate went down to 20. But for almost 100 years in the US, dividends were taxed at a much higher tax rate than capital gains. In 2003, as part of the Tax Reform Act of that year, for the first time in US corporate history, the tax rate on dividends was brought down to 15% and matched up to the tax rate on capital gains. Monumental change, right? Is it going to change the way companies pay dividends? It absolutely did. In fact, the quarter after that tax law change, Microsoft paid its first dividend in history. It was a $33 billion special dividend, the largest dividend ever paid by a company up to that point in time. There's no way they would have done this if the laws had been what they were pre-2003. So clearly taxes affect dividends. That 2003 tax law, though, came with a very strange sunset clause. Part of the reason was political. They didn't have enough votes in the Senate to actually make it permanent. So they made it a 10-year law. The entire Tax Reform Act had a 10-year life. And at the end of 10 years, you know what was going to happen? It was almost as if the Tax Reform Act never existed. Strange way to pass tax law. But the rationale was, somebody's going to do something sensible within 10 years and fix this problem. We're talking about the US Congress. So guess what? You get to October of 2012. There's 2 months to go in the 10 years. And nobody's done anything yet. This was the famous fiscal cliff that some of you probably were too busy doing other things. But there's a fiscal cliff coming December 31st of 2012. What was going to happen on December 31st of 2012? The day after the law, after the law kind of elapsed, you are going to go back to what the tax law was in 2002. When dividends were taxed at 40-something% and capital gains were taxed at 20% or 15%. So guess what companies started doing in that last quarter? This was their last chance to pay out big dividends. You saw companies declare special dividends. Las Vegas Sands alone paid, I think, a special dividend of 10% of the stock price. Because they wanted to get it in before the tax law changed. Congress did fix it. You know when they did it? December 28th. They fixed it, and the tax law was left relatively intact, but the tax rate on dividends and capital gains now is about 24%. Yeah. But they're both at 24%. So for at least since 2003, the tax rate on dividends and capital gains have converged, and it has affected dividend policy. Again, let's look outside the US. Outside the US, you have big differences. In the UK and Australia, if you're an investor who receives dividends, before you pay taxes, you're allowed to offset the taxes you'd have paid by taxes the company has already paid. So let me give you an example. Let's assume you receive $100 in dividends, and the company has a 30% tax rate. In effect, the company has paid $30 in dividends on your $100, right? Let's say your tax rate is 35%. You'd have paid 35, but since the company's already paid 30, your dividends due, your taxes due on the dividends will be only $5. So in the UK and Australia, investors actually get a benefit from dividends as opposed to capital gains. So guess what Australian and UK companies love to do? Pay big dividends. Tax laws have consequences. So if you look across the world, you'd see big differences in how dividends and capital gains are treated. In India, for instance, until very recently, you didn't pay taxes on capital gains. 0 tax rate on capital gains. You did pay a tax rate on dividends. It affects the way companies set dividends. Fourth, and this I think is the most striking trend in dividend policy in the US. When I took my corporate finance class when I did my MBA, the corporate finance chapter was just about dividends. The dividend chapter was only about dividends because that's how companies return cash. In fact, in the early 80s, you hardly ever heard of stock buybacks. They're almost never done. But starting in about the mid-80s, you started to see stock buybacks start to climb. So in this graph, actually, what I have are dividends and buybacks each year. So basically, it's tough to kind of tell the difference. But the first column is buybacks, the second column is dividends, and I've kind of tracked them over time. And I've also listed out the proportion of cash flows that U.S. companies have returned in the form of buybacks. So in the early 1990s, for instance, that proportion was about 25 to 30%. So that by then, buybacks are already kicked in, but they were only 1/4 of all cash flows. But if you look at that number, increasingly more cash has been returned, especially in the last 15 years, in the form of buybacks than in dividends. And this is a big controversial issue. People wrestle with it and say, what does it all mean? So I have a question. I mean, clearly the trend you cannot ignore the trend. US companies are increasingly using stock buybacks to return cash to stockholders. Why do you think that shift has happened from dividends to buybacks? And as you think of a reason, I also want you to think about how that reason did not work prior to 1990. So if you give me a reason saying this is it, I want to say, did it also apply before 1990? And if it did, how come companies didn't do it before that? So what explains the shift towards buybacks at US companies? Yes?
When there is a buyback, the stock price rises.
Okay.
Now CEOs have variable retribution.
Okay, so first is compensation has shifted from traditional profit bonuses and salaries to tied to stock prices. And we already know what dividends do, right? On the ex-dividend day, your stock price drops, even if it's a good dividend, but buyback. So the first is compensation. How would you test that hypothesis? What kinds of companies should be the biggest stock, do the most out? So if I took, you gave you 8,000 US companies, and I said, test out this hypothesis, what would you relate to what?
Well, I would relate the stock price increase.
No, but actually tied to compensation, right? But in a sense, you have in fact, in Capital IQ, they tell you what percentage of top management compensation comes from stock. So if I took the percentage of compensation that comes from stock and looked at buybacks, companies with higher proportion of, in fact, options are the bigger culprit, right? Because options you actually are very closely tied to what the stock price is. So maybe those companies where compensation was increasingly option driven would be the companies that do the most buybacks. I actually tested this proposition out about 3 years ago. There is a relationship, but it's a very weak relationship. In fact, the companies that do the biggest stock buybacks are companies with, like ExxonMobil. Top management have very little stake in the stock price. They get traditional fixed salaries. So it might be a reason, but it's not the driving reason. But that's one thing to think about. What else? Yes?
Management wants to be quarterly earnings per share numbers, so.
And okay, so the per share, that's actually a good point, which is if you have per share targets to meet, you see how buybacks help you? What do buybacks do? They reduce the share count, and by reducing the share count, maybe they make your earnings per share look good, and accretion and all the nice stuff kicks in. So maybe the increase focused on per share numbers as opposed to aggregated numbers should make the difference. Maybe that's it. So those two are management. So we talked about the conflict between what's good for man. So maybe this is all driven by what's good for managers. Yes. Increase pressure from activist investors to do what? So they want more cash back, right? But why can't I pay it as a special dividend? So I can see increased pressure causing companies to return cash, but I can return it in one of two forms. I can pay it as a special dividend, or I can buy back stock. Now we're on to something. What dividends are sticky, she said. What does that mean? When you increase dividends, you're kind of stuck with it, right? With buybacks are temporary, which means if you have buybacks and next year is not a good year, you don't have to do buybacks. That's always been true, though. So what's happened since the 1980s that makes stickiness a bigger problem? Yes?
Maybe just a company makes this difference. So back in the 1990s, it was more manufacturing based, but now it's more technology based. Manufacturing is consistent cash flow while technology varies.
In fact, that's a very good point. 25 years ago, 30 years ago, if you asked me to list out 100 companies with nice, stable earnings, I'd have no trouble doing it. It's not just utilities, not even manufacturing. It's just companies with nice local markets. You control the market. So that was one of the advantages of not having globalization, right? Your income was predictable, increased dividends, you felt pretty comfortable. Today you ask me to list out 25 companies with predictable and stable earnings. I'm going to have a really tough time. Even companies like Coca-Cola and McDonald's, look at how much pressure they're under to deliver earnings the way they used to. It's become much more dangerous to increase dividends in this world than the world we lived in 30 years ago. In fact, I'll use my daughter to bring home. She gave me this story to tell, which I think brings home the reason we paid dividends. And you'll remember the story, even if you remember nothing else about this class. So she's about, as I said, she's a senior at William & Mary. She's going to graduate this year. This was when she was 8 years old. And I was given the task of ferrying her to a birthday party. So she gets in, she was a tiny little person, so she had to get into a car seat even at 8. She straps herself in the back, and then she yells out to me to change. She demands that I turn the radio station to Z100. Station that I think plays the same song all day long. But no, initially I said, can we listen to some jazz? And she said, I don't like that moaning and groaning and all the rest of the stuff. She's very persistent, so I basically changed to Z100 and started driving. And then the song ends and these DJs come on and talk to each other. I have no idea who they're talking about or what they're talking about. But they start talking about hooking up. To show you how disconnected you get after 25 years of marriage. I had no idea what they were talking about. Then my 8-year-old pipes up from the back telling me what hooking up is. Now part of me is in shock that an 8-year-old would tell me this. The other part of me is saying this is a great way of thinking about the difference between dividends and stock buybacks. Dividends are like getting married, right? In sickness and in health, in good times and in bad times, you got to pay dividends year after year after year after year after year after year. For stock buybacks, I like hooking up. 5 billion, don't know your name, bye-bye. And increasingly that is what's happening with companies. They don't want to get married to investors. They have no desire to get connected to investors. They say, look, here's the 5 billion. We never knew each other. Let's move on. And I think this is not just going to be a US trend. It is going to happen globally. It's already starting to happen globally. Is companies are starting to move towards buybacks. Because let's face it, dividends never made sense in the first place. Why? Because equity is a residual claim. Who the heck pays a residual claim and says this is what it's going to be every year, right? So why do you think companies got stuck in this fixed dividend policy? Because that's where equity markets were born. They were born as competition for bond markets. You were trying to get investors away from corporate bonds, and the way you did is you promised a fixed dividend. So maybe buybacks are what you should expect. So I'm going to finish with this slide which actually kind of captures what the 2015 numbers are showing you. And you can already see that across the world, you're starting to see buybacks kick into the game. So this is not just the US. The US, 57% of the cash is buybacks. It's still the highest. But look across the world. India is very low still, probably because of restrictions on buybacks. But across the rest of the world, you're starting to see this number go up. So this is no longer just a US phenomenon. It's a global phenomenon. And I think it's just going to get stronger over time. Let's finish there. We'll pick up with why companies pay out what they do next session. Interest-bearing either, right? And they don't show up as operating leases I look at, and you convert them to debt, right? So.
And I saw in your file that when you calculated the synthetic rating, you would include not only the interest expense, but also the operating leases.
I have to, right?
Okay, and then you have to do a change in the EBIT as well.
But for Netflix, you don't have to do it, right? You have the actual rating.
I have the, yeah.
For that, the synthetic rating is the synthetic ratings process is more critical when you don't have a rating, when you're trying to estimate the rating. But if I have to estimate a synthetic rating for Netflix, I have to take into account the commitments from content commitments as well, because it's a cash flow that they have to meet. So I think it makes sense when I do my rating for Netflix that it reflects their risk as a company. That's part of the reason their actual rating is so low.
And then the change that you do in the EBIT part to calculate the interest ratio, why would you reclassify the part of the EBIT too?
Because once you decide operating leases are not operating expenses, you got to take them out of the operating expense column, right? So your operating income, you got to add back the lease commitment, and once you capitalize leases and you create an asset, you have depreciation. So in a sense, once you decide to capitalize leases, everything changes. Your balance sheet gets different, your operating income gets different, your income statement in a sense has to get redone the minute you do that. Which is what they do with capital leases already, but we're doing that with operating leases and content commitments as well.
Okay, so because I did all that and calculated my own synthetic rating with everything, and then when I went to do the optimal mix with your file, I found out the way that you calculated was a little bit different from what I've done. I should use your numbers from
Well, in the capital structure spreadsheet, I ask you to enter the raw numbers. I said, just enter the actual operating income. I'll do the fixes for you. If you decide to do it all yourself, then when you go to the capital structure spreadsheet, make sure it doesn't get double counted. In other words, you adjust the operating income for leases and for content commitments, and you come up with that number, and you enter that as the operating income. Okay. Don't say yes to the lease question. Just say no and enter the numbers yourself. You see what I mean? So when you enter debt, you'd add on the lease debt and the contract commitment debt that you've already computed. If you let me do it and you do it as well, we'll double do it, right? So basically, in the capital structure spreadsheet, either go with the raw, just whatever the operating income is, whatever the interest-bearing debt is, and then let me compute the leases and the commitments as debt and bring it into the process and adjust your operating income. Or you do it all and give me the numbers and say no to the lease question.
Okay. Thank you.
Hey, kind of random question. How would you account for a revolving line of credit? That's what your company uses.
Recorded in yes. But the revolving lines of credit can get used or not get used. So you can have a revolving line of credit that you never use, with
Right.
zero debt. But if they use it, it should show up on the balance sheet and show up as an interest expense on it.
Right. So you would just record whatever percent of the line they're using. Okay. And then my second question to go along with it is, in terms of like the optimal. So I have my company basically has no debt except for this revolving line of credit.
Right.
Is the only reason why that would be a bad thing because they could be like like what we were talking about last week, like the hostile takeover, or are there other, and like the interest
They're
expense piece of
underlevered.
it?
They're underlevered. They're
Yeah.
revolving
So,
line of credit.
yeah. But they also don't do. It's Sturm Ruger, the handgun maker. They also like don't do a lot of projects. They basically just like make and sell guns.
And do they have one class of shares, two classes of
One
shares?
class of shares.
They could potentially be taken over.
Yeah. But and that's the risk. But there's not. But aside from the interest expense and the potential for
Yeah, there's
takeover,
no-
there's not really a lot of downside to
No,
being
no.
underlevered.
And they can react quickly. If somebody tries to take them over,
Right.
they can preempt them by borrowing money on their own.
Is it also one of my other question about it was? Is it also have to do with like management tendencies, like longer, like it's an old American company, like there
It
just isn't
could be. It
adversity
could also
to
be a
debt?
worry about legal contingencies, right?
Yeah.
Because you're a handgun company today,
could
you
be
never
sued.
know when you could be the next tobacco. I mean, there are
Yeah.
people already lined up ready to sue the handgun manufacturer.